Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to early session update for Monday, July 7th, 2025. It's 11:17 a.m. Eastern Time, so we're a little less than 2 hours into the trading day. Obviously, last week was an abbreviated trading week with the markets closed on Independence Day, July 4th, and an early session closed before that. So, as I often say, that's typically what I call peak summer doldrums week. So don't read. Well, nothing really happened. There's nothing to read into. The markets have just kind of flatlined recently. So I'm going to go over. Here's what I'm going to do in this order, roughly. We're going to start out with the equity markets. I have VIXY up first because I don't want to forget to cover that. I've been, giving you relatively frequent updates on this one. This is the one of many VIX tracking ETFs out there. This one's just kind of the proxy I use for Trade Idea. It's ETF, so you don't have to deal with the K1. Some of these are ETNs that'll track this, and it's also short-term futures. Just real quick, for those of you that trade this, because I get these questions all the time on the days of VIX moves, have a big move in the VIX. Remember that there is no way to trade the VIX. The VIX spot, it's a hypothetical index with you can look at the calculation behind it, but all you can do is trade derivatives on the VIX, which are the futures, and they have the near month, the farther out, midterm, longer term futures, whatever contract you want to trade. Typically traders, they'll usually do the front month, the near term. And that's what this one tracks. And so the VIX can be up any given percentage on a day. And these ETNs, ETFs, some are leveraged, some aren't. Some track the medium-term futures. This is the short-term futures. I just want to get that out there for those that you might notice the difference in daily price moves. And as talked about many times in the last couple years, we've been long at these divergent lows. I'd really like to see positive divergence on this daily time frame and the 60-minute charts. Same thing holds true for my stock trades and index trades on the major indexes sectors. And just like I like to see, ideally, for trend change calls, the bottoming plays on longs or shorting on whether it's a stock, commodity ETF. I like to see divergent highs. Don't have to have them, but they help to have that. It's indicative of a trend change, and again on both the daily and 60-minute charts. So that's what we have here. And so in the last couple years, there's been three major trades we positioned long on at these divergent lows. We hit that one to almost to the button. Give you right here in advance 3 price targets, 127% rally up to it. And then we were long again on this last time around, and it's been more of a opportunity to reverse and take profits and or short the VIX on these tags of the first, second, and this is still my third target. I know many of you listening to my voice. I can tell from the comments on the site. I can tell from sentiment out there in the general public thinks this market now will never go down again, and actually I like that. That's kind of what you need in these strong, resilient uptrends. You need that belief in the masses to just kind of capitulate, bears giving up on shorting, and bulls giving just resigning themselves to the fact they can buy any dip and they'll be okay. And we've seen that. I'm reading a lot about the dash for trash, meaning low price stocks with no earnings or companies that are losing money starting to really lead the pack here in the last couple weeks here, and that is indicative of a late stage bull market rally. So all I can tell you look, I can't promise you anything. We can have a blow off top in the stock market, something similar to 1999. Anything's possible. I really don't think that's going to happen. I go off the charts, and all I can tell you definitively is I've been talking about it. Gave you a scale back in zone when we hit T2. We went below that scale back in zone. But right now, what we didn't have, and when we hit that scale back in zone, is positive divergence here on this daily chart, which we do now. And that's what I wanted to point out. This is the first and only divergent low we've had in the last, the first and only of 3 divergent lows we've had in the last few years. And again, those 2 previous divergent lows, and just this VIX track in ETN, the VIX itself did better, which it almost always does. But, these were all good for triple digit gains, 100+% profits. And if history repeats and we're going to go up, we've already checked T2 twice. Really, at this point, if you want to level, and remember, this is an ETN, it doesn't do a perfect job of tracking any of these ETF. I'm sorry, it's an ETF, but it tracks futures. Just like a lot of ETN track commodity futures, and they do a good job, as good as they can. If you can trade futures, great. That's what I like to trade. But if you can't, just keep in mind you're going to have decay over time, especially on these VIX tracking ETFs and ETNs. But I wanted to point out now they've established, VIXY has a resistance level right here. We had that brief overshoot at T2, which came right in with that first target there that I had on that previous trade. And now that is a likely checkpoint, if you will, resistance level. And I still maintain this, but this, as I've stated since the trade was first given to you back here, was kind of a rough target. I always look at the spot VIX when trading any of these ETFs or even the futures, and I'll assess the spot VIX if and as the charts develop. But I can tell you right now we're at uptrend line support. The spot VIX now did bottom, and this is, again, for whatever reason, this program keeps dropping my trend lines on my PPO. But there it is. We had a divergent low, as you can see on the actual VIX. This is, again, the spot VIX right here on this weekly chart. Big divergent low, initial shot up. We've been making higher lows despite the stock market going to all-time highs. That should usually tell you something's going on there. And just like we did right here, there was the peak, the VIX bottom there in early to mid 2021, but yet the S&P 500 went up, the stock market, which this is what the VIX tracks, remember, the S&P 500, until the very beginning, about the first day of 2022, right in the start of the year, and you can see the same thing, the VIX was moving up then. And then what happened in that, as many will call it, bear market, we didn't see any type of fear, or not fear like we've seen in the past. This is the level where corrections have ended since the last real bear market back in 2007 to 2009. That was the last, again, real bear market. And this is where the real bear markets ended. If COVID was a 36% drop. It was, if you blinked, you missed it, 6-week drop in the S&P 500. But that's where the VIX went to then. And that's where I think we'll go this next leg down. And all the ingredients are there. We just need that catalyst, like I've been talking about, a nice reversal. And then, for those of you that are still listening to these videos, and again, I'll get to some other things in this video. I'm going to get to natural gas, treasuries, crude oil, and then, time permitting, the grains. But the one thing that I've always observed and talked about on the site, sentiment is ephemeral. It can change, and it will change. And when it starts to go the other way, it can change on a dime. And then what happens is the headlines start to change. Right now, bullish news is treated as bullish news. Bearish news is either ignored, shrugged off, or spun somehow to be bullish. And then that kind of starts to go the other way once stocks start dropping and once support levels get taken out. But again, guys, all I'm telling you is these are the major. This is, again, a weekly chart of the VIX. You don't get many divergent lows on the weekly chart. You've had 1, 2, 3. This is how I have it marked up. Again, for whatever reason, the charting platform lately has just seemed to want to drop off my PPO lines. I don't know what that's all about. Maybe I can't remove the indicator and added it back on at some point. But there it is. I used to have these all drawn up, and you can see them just replicating them again. That was actually a divergent low right here. And that was, there you go. So you can see there's not many, and more often than not, they are followed by major trend reversals. Now, here's the thing, and this is it. The $1,000,000 question was this and this. That certainly happened after that divergent low. But was that it, or were those early shots across the bow, just like we had spike, 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 and then finally before all was said and done? Remember, the bear market didn't end until right here. And I talk about that a lot. The VIX will usually peak before stocks bottom in a correction, or especially in a bear market. So we'll see. Only time will tell. but that's where I think at some point by the end of the year we'll most likely see. And again, what I was trying to get at before is it takes that belief that the recession odds are now off the table, bear market odds are off the table, and we're in some new super bull market. But let's go off the technicals. Right now, VIX is still, you can see it, uptrend line support as well as price support here on this weekly chart. And on the daily, we also have that, I don't want to say requisite positive divergence, but again, something that is typical to precede the big spikes in the VIX. That one, you only had it here on the RSI, not on the PP. You almost had it roughly flatline divergence. You still had that spike. And but this all, that spike one off this big divergent low here. This is the bigger divergence that I just showed you on the weekly that's been building. And then this is that new, on the daily chart here, that new divergent low that we have. So again, on VIXY, these targets may be tweaked. I'll kind of follow the charts. And I wanted to mention too on VIXY, as well as the VIX futures, we also have clear positive, aka bullish divergence on the 60-minute chart, just like in the indexes in reverse. Let's jump over to the indexes. Let's do that now. Let me just go big picture, because that's what I told you I'd do. Last month, we ended the month on this sell signal again. This is one of many trend indicators. It's not a be-all, end-all. There are others that are, other trend indicators in certain conditions that remain bullish, such as the markets being above the 20-month moving average, above this primary blue uptrend line. You can see on SPY, this is the S&P 500. That is the bull market, secular bull market uptrend line since the 09 lows right there, March of 09, when the S&P bottomed. And so by many metrics, the bull trend, a larger bull trend's intact, but one that's been has virtually zero, false signals, if you will, are these PPO histograms, again, covered many times in the past. There's one little cross there, and you had a nice correction. But the biggest drops, again, the biggest corrections, well into the, low double digits to mid to upper double digits. Bear markets, again, we're looking at a long-term chart going back in the 90s, have all been associated with those bearish PPO crossovers there. That one was 22% right there. That one was 15%, and really a sideways market for a while, 20%, 36%, 27%. And so we'll see. Now, today's July 7th. We've got 3 more weeks to go. We'll see where this one goes. I just wanted to point out, what you also have, and it's you don't get it very often, and you haven't seen it this big really ever, going back for decades, is big negative divergence on the monthly time frame. Something that's quite unusual. You only get it every few years, and typically every time you've got it, or had it, I should say, you've had big drops, anywhere from the Great Recession, 57%, the bear market after the tech bubble, the dot-com bubble back there, 51. And remember, that's the S&P. The NASDAQ fell almost 80% back then because it was a bubble in the dot-com stocks, just like we have a bubble now in AI stocks and then semis and everything related to that. So when that trade, not if, but when it buckles, you're going to see a lot of hot air come out of that sector, and you'll probably see the NASDAQ 100 outperform to the downside, meaning drop more, unless there's a financial crisis again with the banks like there was back in '08. That's the one instance where the NASDAQ and the S&P kind of fell in lockstep because of the banks all failing and the government had to bail them out. And I say that because the S&P 500, the financials back then was, I think, the second largest sector right behind tech, maybe even number one. It's still one of the top 3 sectors. I think the second largest in the S&P 500 now. And the NASDAQ has very little weighting, virtually nil in financials. And so that's why you get the difference. But one of the reasons the indexes will, NASDAQ goes up more in a bull market because it's tech stock heavy, high growth company heavy, and it's not as diversified with, financials, utilities, all those steady eddy stuff. So just zooming in tight, nice and tight to where we're at now. Again, this is long-term, bigger picture, guys. You have this uptrend line, which was taken out right here. That was one of the reasons, for the sell signal we got back in the beginning of the year. Swung it down. There were many reasons to cover our shorts there, which we did, and go around and go long. And the bounce is pretty much gone to about the upper limits of where, when we were coming up to the 200s, where I said I had a bounce target zone. That was my preferred scenario for where to turn down, but all along, I've always been, and still was and still am, open to that scenario of a marginal new high, because that's just what the market seems to do. And told you that if we got it, which we did now, that it would be guaranteed to be a divergent high. And breakouts that occur to new highs with negative divergences and overbought conditions have a much higher failure rate, a very high failure rate. Versus those breakouts that don't. Let's just go through the other indexes. So QQQ, again, this is what I'm watching. We'll watch to the end of the month. PPO, the PPO histogram is just the differential of these two lines. And sometimes it looks like you're going to cross and then you get a rejection. So we'll see. We'll see how we finish the month. Just to cover all the other indexes, QQQ, still there, still red histogram. And on QQQ, you have again, this has been the leading index, the strongest one due to the AI overweighting in tech stocks here. And there it is. So we had a intra-month breakdown through my beloved 20-month moving average. Great best trend indicator for simplicity. If you factor in, I give it a 10 on trend indicators. And my scaling has to do with simplicity factored in with effectiveness. You can have these very convoluted formulas on the market, multiple moving averages, other things out there, other indicators. But if you have one single indicator, that's all it is. You're either above or below this line, and all that matters is the monthly closing candlestick. These little intra-month breaks don't matter. They're candlestick shadows. You're on a monthly chart, so it matters how you close that. So that big drop in April, we went below it intra-month, but closed solidly back above it, clearly above it, and we're still above it now. So on that's bullish. This is bearish. Again, so there's a cross current. But what we also have, again, there's a lot for everybody, the bulls and the bears. We all see what we want to see. I try to analyze the charts as unbiased as possible. And what I see is a breakdown, a kick back off the primary trend lines I showed you a second ago in both SPY, the S&P 500, as well as the NASDAQ 100. This yellow trend line comes off. The NASDAQ was the only major index that peaked back in the fall of 2008, put a subsequent slightly higher low in, and that's where that trend line comes off of. And it's just a beautiful trend line. When I say beautiful, lots of clean reactions. The kissed it at the bottom of the month. And I just can't emphasize how important this trend line is. And that's the one that we checked at the lows there back in April, right after liquidation day, took us down to that level. And you can see this is you got to have patience and understand the time frame you're trading if you are trading a long-term chart. So breakdown, kick of the trend line, and now a back test. We've been back testing now since last month, close to it the previous month. And what you like to see a back test, problem with it, you can keep back testing, or you can actually regain the trend line, get back above it. That's going to be bullish, especially if these divergences get taken out by going over those previous highs. But as of now, that's not the case. You have the divergence, you have this trend indicator on a sell signal, and you have a back test. What I like to see, as I said, the problem with shorting a back test or getting too bearish on it is you can continue to back test. And when you're back testing an uptrend line from below, uptrend lines have a positive slope, rise over run, right? Remember, mathematics 101. And what I like to see then is a big red candle, rejection candle off that. Once you get that, you're usually good to go. All right, so we don't have that yet. Again, I'll be revisiting this at the end of the month for sure. Might do a couple mid-month updates where we're at. And then the next step would be, so a red candle, whether it's this month or 3 months from now, off the trend line, as long as we're still back testing it. Next thing would be a solid red close below the 20-month on both QQQ and SPY. And then it's lights out when these long-term trend lines get taken out, and that will sharply increase the odds of my longer-term targets being hit. on QQQ and SPY. Just to show you the rest of the lot, VTI is the, like I like to say, probably the single best ETF for the stock market. You can see I have dual trend lines here, uptrend lines off the '09 lows, one of them right there, and then this parallel trend line that just does a pretty good job as well of coming into play on these major moves. Just like everything else, divergent high, breakdown, kickback rally, marginal news, slight divergent high, still in a sell signal with the PPO trend indicator down there. And then we also have the small caps, still very much also, PPO histogram still solidly negative, and that one is still below its highs right there. Big divergent high, just like you had a divergent high right there leading up to the COVID drop. That was well over 36. That was about almost a 50% drop, 45% drop. So these are your divergent highs in recent years. There, and there. And that was the bear market in 07 to 09. Big correction there, well into the double digits, over 20%, another 20+% drops there and there. And this is just the biggest divergence we've seen since leading up to the financial crash. Actually, even bigger than. Okay, so that's it. And then let's not forget the mid caps. I don't cover them often because they're kind of, the charts, you almost split the difference between the small and the mid caps. The chart's usually going to look somewhere in between there. But it is a very important and often overlooked sector of the stock market. A lot of the big names, they're in that kind of fast growth mode. They're more established than the small caps, and just a lot of good opportunities there. Beautiful. Just all I can say about it is a beautiful bearish rising wedge. There's your negative divergences right there under the wedge. We had a breakdown, and we've been back testing that wedge from below. And so we're just waiting for number one would be a rejection candle, whether it comes this month or, like I said, 3 months from now, whenever. And then a break back below there. That would be huge, 523, because that would be a failure. This was all-time high. We broke out, tested for months, about 6 months of back testing. Recently back tested again. Intra-month broke it, but it doesn't matter because we parked that monthly candle right back on there. And so that's it. So again, there's something for everybody in these charts. Bulls see a breakout and so far a successful back test, right? And bears see a breakdown right now of a primary trend line and a back test, but need to see the rejection and then need to see 523 go to open the door to a much bigger drop down to the primary trend line right here off the '09 low. And that intersecting 428-ish resistance. I'll probably put another level right about there too. So somewhere down there. That would take the middies down about, at least to that level, be about 25, 28, 30% drop, something like that. And just to drop down to the daily charts, because they are very much important too. And also, kind of get you in and out a little quicker. This is what MDY, the mid caps, look like here. Again, if you're trading via the ETFs or in your 401k, you had a divergent low there. You can see my charts. That was bullish. That divergent low was followed by this rally that ended with a divergent high. That was followed by that drop that ended with a divergent low. Again, lines have been disappearing, but that you had RSI divergence right there at least. And that was this rally here. You had a little divergent high there and a shot across the bow. That was the first divergent high. Then you made a second divergent high, another correction, and a much bigger divergent high. And this is what happens when divergences extend. There are no guarantees that they will play out, but much more often than not they do. And the bigger they get, typically the bigger the drop, right? And then we didn't have a divergent low there at the bottom, but we were covering shorts going long for other reasons. And now we have come full circle. And again, this chart, I think, has something for everyone, both the bulls and the bears. I'm going to give you my analysis. Bullish is that we had a primary downtrend line, which was broken and back tested, just like on the small caps and a lot of other things. And then we've rallied off that level. So that is bullish unless that breakout fails. We also took back the 200 days. We lost them both right there. It's these blue and red lines. Hopefully you can see them in the video. And then we rallied back to the 200 simple, got rejected, rallied back again, rejected again, and finally took it out. So all that is bullish unless it fails. So I have a really nice price resistance there, about 560, 78, give or take. You can see it was support here, nice support shelf. Finally, that support broke, and so we back test. So that is a breakout. 110% bullish on face value until and unless it fails. If it fails, it's get out of Dodge bearish, because that is most likely, I know that it is, because I follow the actual sentiment survey. There's different sentiment readings, put to call ratios, and then my own, just kind of turn on the TV and listen to this, the bobbleheads speak and the people who march out on TV, and even some here that have capitulated. So you need that to kind of clear out and set the stage. If we are going to have the drop that I still think is coming, you've got to convince the masses. It's kind of like one of my favorite movies, The Usual Suspects. If you remember that movie, I think it was late 90s, maybe early 2000s. And it was Kevin Spacey's character, Kaiser Soze, who said, the greatest trick that a devil ever played is convincing the world he didn't exist. Talking about his true character, Kaiser Soze, the bad mastermind criminal there. Anywho, and you have to have that in a bear market, at the top of a bull market, to set the stage for a drop of 50+%. You just have to have that collective mindset, just like it did back in 1999 and really in 2007, that just wasn't possible and it wasn't in the cards. Otherwise, the reason is because if most thought it was going to happen, they'd be positioned for it. Even if they were bullish, hedge funds, mutual funds, pension funds will load up on put protection to protect their downside risk if they think it's likely. That's a costly strategy. It's not cheap and it's not free to buy puts. So you got to get to the point where no one's expecting it to get it to happen. So, all right, I gave you the glass half full, and now I'll give the glass half empty for the bears. This is a textbook bearish rising wedge with my, I want to say the word requisite. It's not absolutely required, but my preferred negative divergence. It's a textbook looking bearish rising wedge with the first time. Remember, this was my scale back in zone on the markets right here up to around the 200-day moving averages, but not above on QQQ. I'll get to that in a second. We took that out, but we didn't have, when we went up there before, we didn't have negative divergence. Now we have that negative divergence. The last time we had negative divergence, I was very clear on it, was right here. That was the last divergent high on the daily charts on all the indexes. I'm just on the mid caps because that's what I finished on. You've got it there on the S&P 500, same thing, a textbook looking bearish rising wedge pattern with negative divergence, which you did not have here or on QQQ when we hit my bounce target zone. And as I stated then, no more shorts above for long-term swing trend shorts, no more shorts above the 200s. I said it before we got there, if we took them out. And then now we've come full circle. We didn't have negative divergence then. It was a shot at the 200-day moving averages. We took out the 200s. It's going to be quite a ways to fall to even get there. And that's where, again, it's more of a stacking in thing. You break this trend line, that's going to be a sell signal. You break this support level, that'll be the next sell signal. And if you get back down below here, the 200-day moving average is about the 500 level. That's why it's purple in QQQ. That's just kind of a lights out level, in my opinion, where I think we'll kind of work our way down here. Volatility will start to expand. You'll start to get some of those good old 3% down days we haven't seen in so long. But this is where it'll begin to accelerate. And this is where most will want to start shorting, but you probably won't be given an objective entry point at that point in time. They're not, in other words, they're probably not going to let you in. You can always get in, but I don't like shorting when you have those big down days. I like shorting at objective levels, breaks of support or rallies into resistance, and things like that. That's what it looks like on the 60-minute chart here. So here's that again. You can see it on the daily as well. It's a marginal new high. There's the previous high right there. We are right now we're up about 2% above the previous highs, and that's exactly what that scenario was, a marginal new high. But now we have the negative, and it would be a divergent high, divergent on the weekly. You got divergence on the daily, and now you just need the news flow to change. On that, I'll speak to it. It's fundamental stuff. That can go any way. I talked about Trump and the whole taco trade, and stated that the man, say what you want about him, but I don't think, even if you're a big fan of him, I think it's hard to argue that fewer people walking on planet Earth living today have a bigger ego than Donald Trump. And because of that, he didn't like it. He expressed his discontent in the public media when everyone started mocking him with the taco trade. Trump always chickens out. So my guess, was it this Thursday, the 90-day extension on the tariffs expires. My guess is he's not going to be as yielding as he was before. In the market, what I read, they say he'll cow down again because he won't want a repeat of, April of this year. Again, just my guess, and we'll see. I think he'll stand a little firmer on those. Again, assuming that everybody doesn't, bend a knee, kiss his ring and agree to whatever terms he wants. So we'll see. But this is the big thing I watch. I watch Treasury yields, and talked about before. This is the first time in modern history that I can recall the Fed losing control of the long end of the curve. If you read the headlines, you know that the Treasury Secretary is not. He's following Yellen's playbook, not issuing long-term bonds, new issuance. That is an unsustainable path, and it's actually a very risky path. By issuing short-term bills and notes, the short-term 1 year, 2 year, 5 year treasuries in the short end of the yield curve to finance our debts, and now Trump's big bloated bill. But what happens if you keep issuing that debt? You're running the risk, more and more debt on the short end. This is the 30-year. So they don't want to sell 30-year bonds. They know the market's going to price them in here. These are where rates are. This is the yield of the 30-year. Again, if you're not familiar, we're at multi-decade highs, or near multi-decade highs. We're at multi-year highs. This thing's broken out. And what happens, so you understand the risk is you keep issuing that short-term, and if short-term rates happen to continue to hold up or even go up higher, we're just going to lose control. And remember, when treasuries coming due, they have to issue new treasuries at the current rates. The Fed doesn't set. Nobody sets those rates. They're set by market forces. Treasuries go to auction, and so if we continue to pile on debt and the bond vigilantes show up again, even on the short end of the yield curve, they may start balking. Remember, Powell may also kiss Trump's ring and take a bended knee and cave into his pressure for Powell to cut rates. But even if he does, Powell only can control the federal funds rate, an overnight lending rate. You can still see 2 and 5 year treasuries, and in those range, start to tick back up, and that would be a major problem for the Fed. And then they're going to have all this debt coming due, short-term debt. On that, I wanted to just talk about this too. This is the same kind of thing for businesses. This article just ran in the journal today or over the weekend. Homeowners who gambled on lower rates are paying the price. So what they talk about, you can read the article if you have the journal, or just Google search that headline, and usually it'll take you to the article and let you read it for free if you come in from a Google search, even if you don't have a subscription. But they talk about all these folks that in the last couple years took out these 6.5%-7% mortgages, gambling, and they were just absolutely confident, as their mortgage brokers were and the realtors telling, oh yeah, you can get in now, buy the house, and just refinance in a year or two, rates will be down for sure. Well, this what happened. That didn't happen. And so they, the story goes on to tell people, some people are underwater, they're looking to refi again, they're feeling the pinch. This same thing, remember, rates are rates, right? And this is pretty much holds true, as I've talked about. Surprised we haven't seen it yet, but it's an immutable factor. condition in the market that corporations, especially small and mid caps that are more dependent on borrowing, are going to have this same issue where they locked in if you had the opportunity. In other words, homeowners like myself and many of you that would have refied here, and just about any corporation in the world that had debt coming due anytime soon. As I said, if they didn't, their CFO, whoever's in charge of making those decisions, should be quartered and drawn. But I think it's safe to say. So, anyways, that debt is coming due, and we know it's going to come due. And the $1,000,000 question on where this market's going to go, if this happens in the coming years versus this, rates continue to go higher, that will play into that would be the fundamental catalyst that many can't see. How can this market possibly go down 50%? I cannot tell you or overemphasize the nature of a vicious cycle. We're seeing it now. We're seeing the hot markets, Florida and Texas, home prices really coming down. I mean, I follow that closely on Zillow and Redfin, really rolling down. Days on market been ticking up, and we're finally seeing the turn in prices. The days on market was holding up for a while, and that's always, as I've talked about in the past, the first sign of a top of a real estate market that's been really hot and extended. Saw that back in 2005, 06. Prices weren't going down right away, but they stopped going up. And again, it's almost like private equity, the way they get to mark their assets to fantasy, we call it, kind of pick a price where they think they're worth, unlike the stock market that values things in real time. But then when prices get reset, they have to recognize that. In other words, if they sold a office complex or a strip mall in Sarasota, Florida, and then or a strip mall sold next to a couple miles down from the one they own, they're going to have to recognize that is now the current market price. So the same thing happens in the housing market. You can list your house at $1 million and think it's worth $1 million, and Zillow told you it was 1.1 on the Z estimate, and you're just hell bent that that's what it's worth. Your realtor told you that's what it's worth. But after 2 years of being on the market at $1 million, you got to start dropping that price, especially if you need to sell. And you drop. That's what I'm seeing here, and in other markets. And then you go to you're 950, 900. You're at 850 now. Boom, the house finally sells at 825. That resets everybody in the neighborhood, and that's what is happening now in the real estate market. And so rates, guys. We'll watch those. Let's jump into rates now. All right, so TYX. There's remember, this is TLT upside down. That TYX is the yield of the 30-year bond. This is the 30-year bond ETF. Just recently, I showed you. I've been covering this on a fairly regular basis, showing you this thing just trades so well to the technicals, at least my style, looking for these divergent highs and lows. Divergent high, we shorted it back then. You can see targets, divergent low, rallied. We had a lot of these. We had trades, whether they're marked up here, the targets or not. I had different time frames, sometimes using ZB, and that's it. So Treasuries, the 30-year bond has been moving. It's been in this downtrend. This is an hourly chart, 60-minute chart, meaning higher yields. And so recently, this last thrust, the fundamental catalyst to help the stock market punch through, make that marginal new high, was us coming off this divergent low, aka positive or bullish divergence. Recently, I showed you that we had a minor uptrend line here. This was just last week, that a break of that would take us down to this level and then this trend line. And now we hit it. We traded on it for a little while. What was that, Friday? Thursday, and then, Thursday. Markets were closed Friday. Oh, thank you. And then, boom, took it out today in one fell swoop. That's a big move down, 1% down in Treasuries. The market's down today, but not down as much. It's shrugging this off as a one-offer thing, but again, the trend has changed, and looks like we may have come full circle, because typically that's what ends these counter trend rallies. Again, if you look back, and this is as far back as I can zoom on this 60-minute chart. I can go back to we're in August of 24, but you can see since then, Treasury, the 30-year bond, has been in a downtrend. That means rising yields, right? These are what we call counter trend rallies, corrective waves. Each one put in a lower high and lower lows. That is 110% right there, the clear definition of a downtrend. And you get these rallies, And surprisingly, the market has been resilient to this. Again, the 30-year isn't as important as the 10, but it is important. Don't get me wrong. The long bond is certainly important. And so we've rallied. It's a pretty relatively muted rally. It was the catalyst that was falling yields, rising bonds, but we've broken down and we're coming off the first divergent high since this one right here. And you can see what, so if, I don't know if it will. I suspect it might. Not, I'm not betting it right now, at least not via bonds. But and we're also at support, so they're probably going to come in and buy it. A 1% drop. That's the biggest drop we've had in TLT in a while. But if they don't, this is what I'm telling you. Just like what all these videos, what to watch for and how to act and what will change things. If we continue lower, it won't be a straight down like I drew it there. It'll be zigs and zags, off these reaction points. But if that happens, and we take out the recent low, that means the yields now have broken out to new highs there. There's TYX. So watch that. And then on let's go to IEF. These are my zones. Put these zones in place early last year, 2024. And for those new, that just says the green zone, which runs all the way. This is the green zone. It's net bullish for the stock market. And that's that punch. That's remember, this is the 10-year Treasury bond ETF. So when this goes up, yields are going down. So this recent punch back up and rally, and that the 10-year was falling yields, that was a catalyst to take the market to new highs. But the 10-year has broken down recently. Nothing major right now, but we're back to my yellow zone where the stock market, if we get in there, we're at the top of it, support. If we get in there, the stock market will usually start to take note of rising yields. Again, I think I color coded them appropriately. Green obviously is good. Yellow is kind of a little warning, caution. Orange, right here, the orange zone, if we get down to that, stock market will really start to take note of rising yields. And the red zone, which hasn't been hit yet, the stock market will freak out. So I have a very high degree of confidence in that. If we get down there, and I suspect we will. If you want to give you odds, I'd say it's north of 50% at some point this year, and that will most likely be the catalyst. It's one of the, I'm not going to say the only way I see, a fundamental catalyst that can take stocks down 50% from where they are now, the stock market, but that's the most likely one, the most probable. So we'll watch it. And we're far away from the red zone now, so I'm not trying to, there's no reason to run for the hills right now or do anything. I'm going to draw another uptrend line right here that may come into play. So just watch this, the 10-year. Just note that, it did break down recently. You go to the 60-minute chart. And, I don't have it marked up here. I have it marked up on the futures here. This is ZN. This is the 10-year Treasury bond futures. And so, again, I've covered this recently. So there was that wedge I gave you last week. There was the breakdown sell signal. And we're coming up on my first, one of the support levels targets. The big level is right here. So if we take that, probably bounce there, and then we come down here. This will be a level where we'll probably enter that orange zone, I guess, in IEF. And there's the 30-year bond ZB futures, and that's that minor trend line I gave you last week. Breakdown back test, and then we broke the primary uptrend line. And we're also, again, coming up to support just like TLT. So this is where they'll probably buy treasuries. That could give it a little up and, reverse the, treasuries start moving up, which I suspect. Stock market will bounce. They'll start buying the dip in the market today. And then the $1,000,000 question, will they turn it green? And will this continue up? And maybe it does. And maybe we put in, maybe we get a bigger divergent high later on. We go up to this next resistance level. But as of now, like I said, we've broken down, and this has the potential to be the end of the run for treasuries. Okay, guys, this is not related to the stock market, but I just wanted to throw this out there. So I took some natural gas today. I'm liking this. I had a little bit of CL that I took from last week just to game a quick bounce, took that out. So I'm out of that because that's my charts aren't clear on CL right now, but I do like this. This is that 60-minute divergence I love to see on natural gas futures. It's a great trading vehicle. These contracts roll all the time, so this one wasn't marked up, but I believe we probably had a trade there. That was the last. Nice, you can see I'm drawing them out. Divergent low, bullish falling wedge, breakout right there, nice rally. This is first target there. You can see we're right now at a potential downtrend. Potential because we don't know, where is it? For some reason, I don't know why that line's like that. Maybe that got moved. Let me do this. This is how it should be. It's a potential trend line because we're coming off that high there and we're not to it yet. So either way, I put a bigger weighting in. I'm going to show you UNG too in a second where it's support on UNG. And we also have positive divergence. So UNG is the ETN. Either way, you can see these are all potential targets right here. And we're coming off that divergent low. Divergence isn't necessarily a buy signal, but I do like the technical posture, and I think it's worth a shot. So I put a little in there and passing that along to you guys. It's not really plenty of upside if it wants to run. Let me go to the daily chart here. Daily. All right, so what you're looking at here on UNG, which is the natural gas ETN, you know, just kind of like the VIX. It looks similar. I don't know why. It just hit me that, you know, you put in those two divergent lows. Each one had a nice double-digit rally. This was a monster trade. We went long natural gas last year off that divergent low and hit my target, my final target on the futures to the button. It was on a Sunday evening. Got that post out to you, a rare Sunday evening post for me that we hit that target. It was 100 and something % gain, both on a long-term trade. It was a trade, what I call long-term trend swing trade, and so that was it. And we hit UNG. Got out there, turned around, even shorted it right off that high. And now we've come full circle. You can see here we have positive divergence. Again, let's see it this morning, so I'm just drawing it up for you now. There it is, divergent low. We also have, remember, over time, you'll get some decay in this because it's an ETN. They do their best to roll futures, but that's what they have to do, and there's expenses and fees. So this is not going to mirror the long-term chart of natural gas futures. But it is good, especially when you go shorter term. You look at the most recent reactions, and I can tell you, this was kind of like a basing pattern right here. We had one false breakout attempt, then we took it out, ran up, and we back tested it there, and we're back testing it again. So we're at support with my beloved positive divergence. We had one recent false breakout, but we came back down, and you still have this wedge forming right there. So anyway, I think it's objective long here. Where your stops are going to be dependent. Are you just going to do a hit and run, get in and out? If so, you look at this positive divergence here on the 60-minute chart. These are old lines, so forgive me. That's where we exited that last one right there. You can't even see it because it was in the Sunday, the pre-market session, right up there. And ended with a divergent high. Just let me know if you're interested. I know right now their comments have dropped off. We just finished the 4th of July week and weekend. Most people aren't even trading right now. I'm going to be off Friday. I'm even going to probably cut out half a day Thursday. I'm going to leaving town on Thursday night. And but I will be around until then. And if you want me to sharpen my pencils and give you some targets here, I'll do that. But I just gave them to you on nat gas futures. You can also just chart that and align any long trade on nat gas or UNG with the nat gas futures. Okay, let's just wrap it up here. I'll continue to hunt for trade ideas. We'll keep, like I said, best to keep keep things relatively light now is kind of my thing, because of just the holidays and low volume, and it's and also not seeing a tremendous amount of good ideas. But I'm still looking for those bottom plays in the stock market. Again, that's where they're going. There's a dash for trash, but I'm also, a lot of the trade ideas I've thrown out to you lately on the long side are solid companies, the Lululemons and Pepsi and Estee Lauder. Again, some of those ideas came from subscribers on the site. Thank you. Keep those your requests coming if you want a chart opinion on anything, and if I like it, I'll even share it with the group. All right, so that's it. There's your ideas for the day, kind of analysis. And again, I start out bigger picture stuff. Don't ever get confused with what a long-term bullish or bearish chart. you need the, the catalyst, you need the breakouts or breakdowns on the shorter term charts, the daily and 60-minute charts. And then there's, like I said, a lot of moving parts in the market right now with tariffs, with interest rates, with treasury bonds, both long-term rates and short-term rates, and everything else. So, all right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.